So, welcome once again, Karina. It's so great to have you here on the podcast. And today we are talking about really the process of buying a home here in Canada and more specifically here in the GTA. So, thank you for taking your time and coming to speak with us today.
Thank you for having me. My pleasure.
So, a lot of people aspire to buy a home. And, there's two kind of scenarios that I see. People who think it's super easy to do so and they can just go start looking at homes. And then there's the other side where they're just overwhelmed with the process and they think that it's unattainable and it's just too much stuff that they have to do. So I thought maybe today we can kind of go through what the process is. And I think if people have an idea of expectations, then they'll feel more comfortable moving forward if that's what they want to do.
Yeah, for sure. And it can be overwhelming. I remember buying my first home. I was 23 and I worked at the bank at the time, but I was so nervous. And the day that we put the offer in on the property, I was literally sick just from nerves. And that's not lost on me. I still think about that today when I speak to first-time home buyers, because it's a huge purchase, right? You're taking on a big debt, the biggest debt you'll ever have. And there's a lot of cogs on that wheel that you need to be aware of. So I think it's great that we're going to go through the process. We can educate people, and knowledge is key. That makes it a little less scary, especially when you know what your payments are going to be per month.
Right. So I guess one of the first elements to buying a home would be to save for your down payment. So maybe you can talk to us about what are the requirements in terms of down payment.
For sure. So if you're purchasing a property in Canada, you have to have at least 5% down on the first $500,000. So that equates to $25,000. Anything over $500,000, you need to have 10% on the additional. So for example, if you're purchasing a property for $600,000, you would need $35,000 down. Now, there are some lenders that will do what we call a flex down, where you don't have to have the down payment. They will allow you to borrow it. So let's say you did a loan or a line of credit, we would have to factor in what the monthly payment for that would be in your calculations when qualifying for a mortgage. So we don't see them as common today, just because when you factor that in, it does also take away from the max that you would qualify for.
Right. So I think if you're going to borrow for your down payment, you'd have to be perhaps somebody who has a really high income. You've just started working and you just haven't maybe saved up enough for the down payment, but your monthly amount that you bring in is considerable, right?
Exactly. Yes. Yeah.
Okay. So we have the down payment. That's, I guess, our first challenge in buying a home. But there are different sources that buyers can use to obtain their down payment. So obviously it can be money that's in their bank account, but it can also be things like RSPs.
Correct. Yeah. So an RSP is a good option. If you already have funds in there, the government allows you to use up to $35,000 of your RSP to do what's called a homebuyer's withdrawal. You have to pay it back. So they'll give you 15 years to pay that back. And if you miss a payment in that year, for example, what happens is it's just recorded as income on your tax return. So you would pay tax on that portion. So if you are paying it back, you also have to keep in mind that you have to make an RSP contribution in that year. So if you need to pay back, say, for example, $2,000 per year, you have to make sure you do a $2,000 RSP contribution. And then when your accountant does your tax return, he has to code that $2,000 contribution as a home buyer's repayment. Okay. So that's one form of savings that you can do. This year introduced was the First Home Savings Account, which I really like. So it's fairly new. Not all institutions have it yet. There are a few that are offering it. And with this program, you can contribute up to $8,000 per year. It's tax-free. So it works very similar to a TFSA, but it is specifically for home ownership. You can carry over the amount each year if you don't use it. So if you only put 4,000 one year, that other 4,000 will get carried forward to the next year. And you can contribute up to a total of 40,000 in a lifetime. So you have to be a Canadian resident, sorry. You also have to be 18 years of age or older or under 71.
Okay, great. So there are some other ways for down payment. And then obviously there's, if you're gifted it, maybe parents or family members are helping you with down payment. Is there any other sources that you can think of for down payment that we've maybe
So
missed?
yeah, you can use your TFSA. There's also the first time homebuyer incentive program. Now, this came out a couple of years ago. You don't hear a lot of discussion about it because I really call it a nothing sandwich. When it was introduced, most of the funds of that program were used in Alberta and out in the smaller provinces because there were some caps on that. It was like max of 4 times your income. And when you're looking in the GTA area, purchasers could qualify for more on their own versus using this program. So we didn't see a lot of traction. I didn't see any traction on it in my business because most of my business is in the GTA area. So it wasn't really, I think it was the government's way of trying to make it possible for people to get into home ownership. But like 65% was used in Alberta, and then the majority was Quebec and Atlantic provinces. So we don't really talk about that one too much because it's for Ontario people in the GTA. It's not really beneficial.
We have our first item that we need to check off in terms of purchasing a home, and that's your down payment. What is another aspect of buying a home that we should be looking at?
So for sure, budgeting, because even though you can qualify to carry for a home, you want to make sure that the payments also align with your lifestyle. You're obviously going to have to make some choices when you purchase a home because you're taking on a debt that you didn't have before if you were renting or, let's say, living at home. So you want to really use a good budgeting calculator or a tool. There's lots online that you can go through and really fine tooth comb every possible payment that you might have per month and then factor in what your new mortgage payment's going to be, your property taxes that will increase each year. If you're purchasing a condo, your condo fees could increase each year. So really get a good sense of overall monthly what your expenses are going to be and what you have left over. So that's very important.
Right. And one of the things I like to sit down with buyers, it really doesn't matter whether they're first time buyers or moving up buyers, is going through that budget. So, for example, say they're qualified for a 900,000 purchase price at X percentage. What we do is we work out the payments at 900, maybe at 875 and 850. And then we say at 850, do you feel comfortable? Yes, for sure. 875, it's okay. Or 900, which is your maximum, I don't feel comfortable. I've been qualified for that, but I just don't feel comfortable. Then you look at what type of homes you can buy. So you may look at something at 850 and you go, oh, this is not enough for me.
Right.
And then you look at 875 and you go, yeah, I can live here. And then you go 900. Oh my God, I love this, but I don't feel comfortable with the payments, right? So like anything in life, it becomes a balance, right? And there's trade-offs. So you have to look at what you can afford in terms of what the bank or lender is willing to give you, and then what you can afford, as you said, in terms of your own personal budget and lifestyle. And always, I think it's a good idea to leave a little bit of room in there for those incidentals and those increases in taxes or maintenance fees or even your utilities, which tend to go up year to year. And maybe your income doesn't keep up to that, right?
Yeah, absolutely. Yeah. It's, when we do applications with clients, we do ask a lot of questions. I ask what their total savings are. And a lot of the times people will just tell me what they're going to use for their down payment. I'm like, well, is there anything else? Like, tell me the whole picture. I don't think it's a good idea to use every single penny you have for the down payment. You do have to have some sort of cushion set aside in case something were to happen. But yeah, I mean, there's a lot of expenses when it comes to purchasing a home. So you just have to be prepared and know what all those expenses would be.
Right. And so, in addition to having the down payment that you need to save up, you also have to save up for your closing costs, right? So
Mhm.
that would be your legal fees, it would be your incidentals, I guess, like an appraisal fee from the bank, your home inspection, your mover costs, your hooking up of your utilities, and then of
Mhm.
course the big one, which is the land transfer tax that is applicable at the time of closing. And if you're living
Yeah.
within the city of Toronto proper, you've actually got two land transfer taxes that are
Mhm.
payable, one to the province and one to the city, which can be quite substantial depending on your purchase price. Now, as a
Yeah.
first time buyer, there are land transfer tax rebates, but it's only on a lower amount. So it's under 500. I think it's 475. So anything over that purchase price, you're still paying that additional amount. So
Yeah, sure.
either way you look at it, because there's not much at that price point, let's face it,
No.
you're going
Yeah.
to be paying some of the land transfer tax out of your pocket as well, even if you are a first time buyer. So yeah, you're right to keep some extra money aside for closing, and then some extra money on top of that just for your safety cushion.
Yeah, for sure.
So, in terms of the mortgage options, right? So, maybe you can talk about some of the different ways that people can structure their mortgages to make it more affordable.
Yeah, so depending on your down payment, if you're putting less than 20% down, the maximum amortization you can have right now is 25 years. We've been lobbying with the government for quite a while to have them extend that to 30 years. If you put more than 20% down, then you get the benefit of having the 30-year amortization. So what that's going to do is help you qualify for a little bit more, and it will also lower your payments because you have a longer period of time to pay the mortgage off. So we're really hoping that that will change down the road. I mean, I remember the days when we had a 40-year amortization and zero down. It was like Christmas. We don't have that anymore. It's a little bit different. So we have to work within the confines of the mortgage regulations. But yeah, I mean, really, depending, if you have more than 20% down, we can be a little bit more flexible. And we do also have lenders that will go to 35-year amortization, depending, right?
Okay. So, I know one of the things that people get really confused on is amortization and the
Mm-hmm.
term of the mortgage. So, before we
Right.
go on, maybe we
Yeah.
should just clarify what those two are so they understand what we're talking about.
Yeah, for sure, especially if someone's coming from the US, because their mortgages work very differently. So in Canada, your amortization you can look at as the life of the mortgage. So you're going to have that debt, carry that debt for that period of time. So let's say it's 25 years. And during that 25-year period, you're going to have terms to make up that 25. So, mortgage terms can be anywhere from 1 year to 10 year. We don't normally see a lot of 10-year term mortgages. Quite frankly, they're just a little bit too long. And, anything can happen in a 10-year period. So right now, the popular term is 2 and 3 year terms, just because the interest rates are a little bit higher. If we go back, let's say a year to 2 years ago, most people were taking a 5-year term. Now, again, it depends on your situation. When you have a conversation with your mortgage broker, they're going to determine what the best term for you. But when it comes to amortizations and term, just think there's many terms to make up that entire amortization time frame. Now, the amortization can also change depending on your monthly, or your payment frequency, I should say. So if you're paying monthly, and you enter into a 25-year amortization, after 5 years, you're still going to owe, you will have a 20-year amortization. If you're paying biweekly accelerated, for example, or weekly accelerated, what happens is each year you're making the equivalent of an extra 1 month payment on the mortgage. So that reduces the amortization. So it could take 2 to 3 years off the life of the amortization. So instead of a 20-year amortization, if you're paying biweekly accelerated or weekly accelerated, you may now drop down between 17 to 18 years. I
Right.
hope that
And
answered the question.
yeah, so I guess just an easy way to do it is to say an amortization of 25 years means if you were to have that same mortgage payment
Hmm.
in 25 years, your house would be paid off.
Right.
The term of the mortgage, whether it's a 1 year, 3 year, 5 year, means the bank is going to give you that interest rate for 1 year, three
Hmm.
years, 5 years. And at the end of that 1 year, 3 year, or 5 year term, you're going to renegotiate how much the interest the bank is going to charge you. And then you'll pay that new amount,
Correct.
if that sort of makes it easier. And I really like that you brought up that position of being able to choose your frequency of how often you pay that mortgage, whether it's
Hmm.
monthly, weekly, or weekly accelerated. Because I think really the amount of that payment is so minimally different, but it makes a
Yeah,
huge difference at the end of your mortgage, right? So
for
for
sure.
easy yeah. So for easy numbers, if it was $1,000 a month, it might be like $500 every 2 weeks or $503 every 2 weeks. It's so little. But
Hmm.
every week, every 2 weeks, you're putting $500 towards your principal, and then you're paying the same payments on an amount that is actually lower. So you pay it off
Hmm.
faster. And then if you
Exactly.
do weekly accelerated, it means you're just paying every week. So it's roughly $250 a week. And then there's a few months, I think it's 3 months in the
Two.
year or something, months in the
Yes.
year that have 5
2 months.
weeks. So you just
Yes.
have to budget a little bit extra for those 2 months that have 5 weeks.
That's
So
right.
it's really, people pick, I guess, monthly because they're not good with managing their money, right? They see the big amount come in and then they go spending. But if you really look at it and you say, here's my income, I need X amount for my mortgage, and you put it into, even if it's a separate account, and then you
Yes.
draw from that, it really does make a difference at the end. And I love that you highlighted that because I find a lot of mortgage brokers don't, right?
That's scary. Yeah. I mean, it's so what I ask clients are you getting paid every second Thursday or every second Friday? And if the response is yes, which most people are, then you should absolutely do bi-weekly accelerated because you can coordinate the payments to come out the day after you get paid. And, you get those 2 months per year where you get the extra paycheck. So why not take advantage of that? You're not going to notice it. Whereas if you're getting paid on the 1st and the 15th, you're definitely going to notice it because on those 2 months, you're going to have an extra mortgage payment come out that you haven't really planned for. Now, if that's the case and you get paid on the 1st and the 15th, if you wanted to attack the mortgage like you would paying biweekly accelerated, you would just do a lump sum payment against your mortgage once per year, equivalent to a monthly payment, and you'll have the same effect.
And
Yeah.
talking about lump sum payments, maybe you can also talk about that aspect of repaying your mortgage, what it means, how you do it, and how it benefits the consumer.
Yeah. So most lenders will offer you pre privilege payments. On average, I would say it's anywhere from 10 to 20%. You can apply against your mortgage, and that would be 10 to 20% of the original mortgage amount. So you can make a lump sum payment that goes directly to the principal. So that's going to reduce the amortization and the amount of interest that you pay over the term. And then most lenders will also allow you to increase your regular payment, and that can be anywhere from 10% to 100%. So the 100%, basically, it's doubling up your mortgage payment. So if you have somebody in a field where maybe it's commission or their income is going to increase rapidly over the term, they're likely going to want a mortgage that has aggressive repayment terms.
Okay, good to know.
Mhm.
So, what about talking about property types and location? And also, if there's any differences in how lenders look at those two aspects of a home purchase?
Yes, for sure. So if we're looking in like the GTA area, I mean, lenders are going to be very familiar with those types of properties. I spoke to somebody last week. I don't even remember where the city was because I'd never heard of it before. It was way up north. They were looking for like a construction draw mortgage, which is a very unique mortgage in itself. So yeah, location's key. I mean, financing can be a little bit more difficult if it is, more secluded sort of neighborhood or you're on the outskirts of a major city. If you're buying, like I know we're talking about first time buyers, but if you're an investor, you definitely location, location, location. You're going to need to think about where it is. Is it on subway lines, close to schools? You want to have a very marketable property if you're renting it out. If you're purchasing it for yourself, then obviously you're going to buy which makes sense to you. Is it close to work, close to family? Are there commuter trains, that sort of thing?
Okay.
And the property
And
type as well. The lender, sorry, didn't mean to cut you off. The lender does also look at the property that you're buying, right? It's their collateral. So they want to make sure it's a good, clean property and there's no issues. So a lot of times, and I'm glad you brought this up because people will say, oh, well, I got a pre approval, so I'm good. I don't need to put a financing condition in. Well, you may be pre qualified or pre approved as the client. So your credit's good, your down payment's good, your income's good, but they have no idea what property you're buying. And the property is the collateral and the most important thing. So if you're buying a property that, let's say, maybe is a century home, maybe it's got old wiring or the foundation's not very good, and the lender likes you as a client, but they don't like the property, that can be a hard stop. So I'm glad we sort of talked about that because that's a big thing. Like people need to know that if you're putting the offer in, you have to be very careful about condition-free offers because the property is very important.
right, and there's also two other scenarios as well. One is properties that are like mobile home communities. I know that a
Yes.
lot of lenders won't look at that. And you mentioned land, and people
Yeah.
think they can just buy land, get a mortgage on it, and get a mortgage for a house. And it doesn't always work that way either. So you're
Yeah.
absolutely right.
Yes.
It's what you're buying that the bank wants to make sure their funds are secure in
Hmm.
that. And maybe we can do another podcast on buying property to build on.
Yeah,
So
that's a whole other animal. It is,
yes,
I mean, that's the dream, right? Everybody wants to build their own home. There's a lot involved with that. That's a completely other discussion, but yeah,
right.
for sure.
And I guess the other thing I meant by property type as well is whether it is a condo, right?
Yes.
So
Yes.
for the condo, I guess the qualifications is a little bit. So if the bank says you're qualified for X,
Hmm.
and you're telling them that you want to buy a freehold property, and then all of a sudden you switch to a condo, but at the same price range, you may not
Yeah.
be qualified for that.
Yeah, because if you're buying to your max, so that's very important. If someone's getting a pre qualification or a pre approval, you have to let them know if you're going to be looking at a condo because the condo fees are factored in and lenders typically will use half of the condo fees, whereas a freehold property we're not using that at all. So that's very important. Typically when we do like a pre qualification for a client and we know it's a condo, we'll tell them max taxes of X and condo fees no more, past this amount. And then here's what your purchase price should be. And then if they see something lower, then they can work within that confines. But yeah, that's a very important point.
Right. Because I know a lot of times when I start with a buyer, they may not be sure whether they want to go freehold or condo. And they tell me they've been pre approved
Yes.
to X. And I say, well, if we're also looking at condo, right? Because obviously, even if you're looking at a townhouse and
Hmm.
you're looking at a freehold townhouse and you're looking at a condo townhouse, they're in the same community. They're roughly the same age, the same amenities, the same size, the same upgrades. Your freehold is going to cost you more money. And the condo traditionally is a little bit less expensive because of that maintenance fee. But
Right.
you can't buy, the bigger condo townhouse and think that you're going to qualify the same as the
Hmm.
freehold. Yeah.
Yeah,
So
very different. Hmm.
and then I guess the other thing that people would have to budget for as part of that process of buying a home is the appraisal and the home inspection. So how
Right.
does that work?
Right. So the appraisal, depending on the client situation, the lender may want one, they may not. It really depends. If you're purchasing a property with less than 20% down, then the mortgage is default insured. And typically, most times we don't require an appraisal. If we required an appraisal, it would be maybe that the lender thinks that the property that you purchased is maybe not worth what you paid or not in line with some other comparables. Or it could be maybe there's a flag on their system with, that type of property or the location. So yeah, that's super important as well.
And roughly how much does a appraisal cost for the purchaser?
Right. So this is sort of a bone of contention with us mortgage brokers. Appraisal costs have changed quite a bit. So it could be really anywhere from $325 up to $1,000. It really depends. If we're looking at properties that are, larger, let's say 3,000 square feet and higher, you might pay a little bit more for a appraisal. If you're buying a property that's in sort of a remote town or a smaller town and there's no appraisers nearby, the appraisal is going to cost you a little bit more because they're going to charge for their mileage and gas, because you may not get an appraiser, he might be 45 minutes away. So yeah, I'd say like 325 up to 1,000 depending.
Right.
Average
And
around 450. 500.
And I'll speak to the inspection portion of it. Generally, a small house or a small condo is probably going to run you about 500. The bigger the house, finished basement, that kind of stuff, it's going to cost you a little bit more. Other things on top of a home inspection, if you're buying a rural property, might be a septic inspection, a water flow test. So to keep those in mind as well. So you'll need to budget for, I'd say probably you want to budget for maybe 1,500 for your appraisal and your home inspection things. You're probably okay.
Yes.
And then if it's a specific property, there's wood burning fireplaces, then you're going to need a wet certification on it. So again, work with your lender on the financial side, work with your realtor on the purchase side, and they can give you a better idea of what those costs will be based on the property that you're looking at for sure. And then, of course, we have our legal costs, right?
Yes.
So the legal costs would be for the lawyer to close the deal and also to register the mortgage. And the closing costs will be your land transfer tax, as we mentioned before. So legal costs, generally speaking, to purchase is a little bit more than to sell, because to purchase they're registering a mortgage on it. So I would say to budget just for the lawyer's fees, probably around 2,000. And again, it depends on where it is and what lawyer you have. Anything else that you wanted to mention in terms of those costs?
Yeah, I think so for purchasers to ask a lot of questions to the lawyers, because sometimes they'll call and say, what's your fee? And the lawyer will say $900, but that doesn't include the disbursements that come along with that. So to be safe, I always sort of tend to budget on the higher side just so people are not short. If they're doing a purchase and a sale, I say around 4,500, depending. If it's just a purchase, between 2,000, 2,500. Land transfer tax, like you mentioned, have to be careful of that, especially if you're purchasing in the GTA area. Although there is a rebate, that can be, you have to know that there's going to be the double land transfer tax. And you have to be a first-time home buyer to get that rebate. We used to say have about 1.5% of the purchase price for your closing costs. I don't feel that's sufficient now. You really need around 2%, maybe 2.25 to cover everything.
Right. And I think it's always...
Yeah, sorry, go ahead.
No, I was going to just say, just like you, it's better to be, over budget and have money left over than budget short and be like freaking out at the end of the day going, I don't have enough money to close this, right?
Yeah, for sure. Absolutely. The other thing too is if someone's buying a new build, that's very different, because the builder can charge you for trees or community, development. So it's a great idea if you're purchasing a brand new property to have your lawyer fully review that purchase and sale agreement. They can go back to the builder and ask for a cap on certain fees, but you have to definitely be aware of that. That's a big one. And listen, most new builds, you're buying it and it's not closing from a year to sometimes 4 years out, and you forget what's in that agreement. So that's a big one. A lot of people get stuck on that.
Yeah, and most of the builders will charge for utility hookup, the tree in the front of the lot. There's
Yeah.
usually a subdivision, like a
Improvement.
binder, yeah,
Yeah. Yeah.
improvement parks, things like that. And also on new condo bills, because you may actually be able to move in, but it's really an occupancy fee, which is a fee that's, I call it like a rental. You're renting back from the
Yes.
builder, and it has nothing to do with what your mortgage payment would be. So you may
No.
be somebody who's going in there with a very little mortgage or no mortgage, and then the builder says your occupancy fee is $3,500, $4,000 a month, and you were planning on zero because you were going to pay it all out. And then you're like, wow, I don't have that money monthly coming
Yeah.
in. So you're absolutely right. You need to look at all those fees and have the lawyer review them with you and write them all down so you do remember 4 years
Yeah.
down the road.
Yeah. And I mean, I don't remember what I did 4 years ago, right? You have to have it review, but I'm dealing with the same thing now. I bought a second property 4 years ago. I just got occupancy. And so what I did to reduce the occupancy was just give the builder the full 20% down. But my occupancy fees are still $3,000 a month, right? So, and it's a small mortgage, but yeah, you have to plan for stuff like that. And it does not go towards your mortgage. It really is
Right.
like right. Yeah.
Hmm. Absolutely. And then
Yeah.
again, there's always the government regulations and all the taxation that comes to play. We're quite heavily taxed here.
Yes. Yes, we
So
are.
to know those and some of the new, I guess, legislation that's come around as to who can and cannot buy right now
Hmm.
property. You have to be a Canadian citizen. And
Yes.
so, they're just trying to make the people that are actually living here and citizens be able to get some of that housing because there is such a limited supply that is available. So, also if you're new to the country or maybe you're not a citizen, but you want to buy a property, to check into that as to whether or not you're actually capable of doing so. Um,
Yeah, there's a lot of limitations on that. So if there's anybody listening that's interested in that, I would just recommend they reach out to a mortgage broker because the rules change all the time. They have made some amendments to that rule as well, but I've been doing mortgages for a really long time. There's been so many changes to mortgages. And for anybody that has been pre-approved or pre-qualified, a lot of times a client will call and say, oh, well, I was qualified by my bank a year ago. That's null and void. It's no longer valid. We're in a rising interest rate period right now. Bond yields are quite high. So, whatever pre-approval I did last week, if the rates change, that's also null and void because we now have to use the higher interest rate. So you need to make sure that you check in with your mortgage broker or lender, whoever you're dealing with, to make sure that your pre-approval is accurate.
Right. Okay, all good advice. Is there anything else that you wanted to leave as a little tip before we close out today's session?
You know what? Just enjoy the journey. Home ownership is amazing. It is stressful, but I think if you work with a great mortgage broker and a great realtor and a good lawyer, and you have your team of experts together, the process will go much smoother. Knowing what your payments are going to be monthly, what the costs are going to be, and doing your budget ahead of time will relieve a lot of that stress. But enjoy the process. It's fun. Yeah.
Yeah, it is fun, and it is, it does have a lot of benefits. Home
Mhm.
ownership, you're building your equity over time. You've got stability in
Yes.
where you're living. You don't have someone saying, you got to move out because I'm selling or
Mhm.
renovating or any of those kind of things. You can do whatever you want with your space. You don't have to
Yes.
ask to paint it or, can I do this to the backyard? And again, it's that appreciation. So, and we're
Mhm.
not taxed on the appreciation that our home has when it's a
Right.
principal residence. So we definitely want to take advantage of that. It's a great way to build your net worth and to save for
Mhm.
retirement and be able to leverage your property to do the things in life that you want to do. So lots of upsides to it. Just as we've mentioned, just know, all of the ins and outs of it. Consult with your professionals. They'll give you the information. They'll also give you options if they're available for you so that you can, at the
Yes.
end of the day, make the best decision for you and your family. And you only can do that when you have information to draw from.
Absolutely.
Right. And you have lots of information to impart. I thank you so much once again for sharing it with us. What's the best way for our listeners to reach out to you, Karina?
So, cell phone 416-884-1428. Can also reach me via email at karina@premiermortgage.ca. I'm also on Instagram, LinkedIn, and YouTube. My Instagram is Karina at Mortgage Girl, or Karina Mortgage Girl, I should say, or connect with Evelyn and she can make an email introduction.
Right. And we'll definitely put all of the contact information in the show notes and check out Karina's YouTube channel. She does have a lot of great videos and they are very informative.
Thank you. I appreciate
Okay.
it.
So thanks so much for popping by today and we'll see you next time.
Thanks, Evelyn. Happy house hunting, everyone.
Bye bye.
Bye.